Let's take it from here. So good evening, everyone, and welcome to our latest episode of the biweekly webinar series. I'm George Ozude, and Dr. Breathe Easy, Biofasania, and I are your hosts. This evening, we are excited to bring on Dave Zook. He's founder of The Real Asset Investor. Dave is a friend of mine who I've come to know over the last 2 years through the Real Estate Guys Mentoring Club, where he serves as an alumni mentor and a lecturer. He is a successful business owner, syndicator, and tax strategist. He and his team have allocated over $800 million in capital across various asset classes, including ATMs, Carwashes, energy, self-storage, and more. The team is also recognized as one of the top 5 ATM fund operators in the country. He's also an early investor in Bitcoin and digital assets and a sought-after speaker with a passion for helping others achieve financial freedom. And tonight, we will be talking about alternate real asset classes, namely self-storage, ATMs, and car washes. Many of our community members have been looking forward to learning about these particular asset classes. And I think it is also a very timely discussion to have in light of the past week's economic news with bank failures. So diversifying where we store and grow our wealth is becoming more and more critical. So with that, I'm very excited to kick it over to Dave. But first, I wanted to let Dr. Breathe Easy start us off with a bit about his journey and experience with self-storage.
Okay, thanks, George, and thanks, Dave, for coming. So the topic today, self-storage, is the one I am accustomed to, that I know at least something about. So I'm very, very excited to hear about the car wash and also the ATM portion of it. But, self-storage, it has been consistently one of our best performing assets. Currently, we have about 5 self-storages, and during COVID, throughout any economic condition, it seems to be one of the most recession-resistant assets out there. And there's data to back it up as having the lowest default rate of any commercial real estate asset class. The reason why we do it really is because of the 4 Ds, right? So we know that there's going to be divorce, there are going to be people having to separate, having places to put their things. And I think the data is like every 13 seconds, right? Someone somewhere files for divorce. So somebody has to move somewhere. And also, part of the reality of life is death, which is the same thing, which is relocation. Then downsizing, which happens a lot during recession, right? So you would think that when people are downsizing, they don't have a place, they can't afford their place to live, you would think that they won't pay for storage. But funny enough is that they go and rent an apartment complex now. And now all those things in their garage now goes into the storage. So it's awesome that way. And then the dislocation, like loss of a job and all those extra stuff must go somewhere. So overall, yes, it's been, one of our most successful assets. The cash flow is very quick also. It's month to month, which means you can raise the rent almost any time based on, occupancy. So it's good stuff.
Hey, so question for you and Dave, like supply and demand dynamics, do you worry about that? Because I feel like I'm in Houston and I see self-storage is being built everywhere. Can this kind of get oversupplied and overbuilt?
I'll let Dave start.
I was going to let you go, but no, I'll go. I mean, look, I 100% agree with you, Dr. Breathe Easy. I like self-storage for all of the reasons you mentioned and more. In answer to the question about the saturation, this is a local business. You're covering primarily a 5 to 7 mile region. And so if you can find a 5 to 7 mile region that's underserved, that's where you want to be. So, and it's very similar to the car wash. We'll hit on that a little bit later, but you're serving a local geographic area. And so you need a number of things. You need rooftops, you need traffic count. You want to be where people are going anyway. You don't, this is not a destination type of a business. But if you're in the right area and you're getting that, you're going into that underserved area, underserved in terms of square footage per capita, you're going to be fine. Big asset, big properties moving into the area that's serving that same clientele. Okay, yeah, now we're talking that could be a problem if that happens. But you're serving a 5 to 7 mile radius.
True. So there you have to look at the traffic count, like you said. So about 1 in 10 household rent storage space. Okay, and especially with multifamily, like for example, the one that we have in traffic crossing in my area, right in front of us, they're building a 240 unit apartment complex. So we know, like literally right in front of it. So we know we have supply for life because it's only 106 units. So, even if there's another storage down the street, we're going to be fine. So, also, like you said, the way you also advertise also matters, right? We advertise online, so it kind of captures slightly more than just the immediate local, so that you could you can capture more of the market, especially if you're in a good area. Like for us, first you have to do the data analysis, right? Before you build your storage or before you buy the storage, right? You want to look at market analysis, but for most part though, if you have a increase in population, right, in the area, same thing like multifamily, you can really kind of gauge if it's going to be able to be absorbed. And what happened in our area is during this, after spring, like towards the middle of spring, if you call, every single storage space is occupied. Literally, like there are students that say, I can't find a spot. So, in that kind of situation, so it's also seasonal. So which sometimes, it's going to be full, and then sometimes you have a mild occupancy issue, vacancy.
Nice. So I want to take a quick moment to invite any of our attendees. If you have questions just about self-storage, go ahead and leave it in the chat. I'll be following along and putting your questions out there. You're also invited to unmute and come on camera and ask a question if you want. So just to let everyone know that. So another question I had is, I think, Bio, you mentioned it's a fragmented industry and sector with a lot of mom and pop where you come in and you do like a value add. What kind of value adds are you doing on the income side or the expense reduction side?
So I can start with that. For us, about 73% of the market right now for self-storage is by mom and pop owners. Okay, so we found out they range between about $1 million to like $3 million. They're not like the large, $10 million property, that you're going to buy. So for those ones, usually they don't have an online presence. Okay, so first is to improve their marketing, improve the way it's been seen, the storage. Another thing is many times they don't have like a security or gate, and so you add those. Those are very important because people want to be sure that their belongings is in a safe place. So usually, we always put that as part of our CapEx. We make sure we have we put camera also. So if there's a little bit of crime, it's been broken into, so you basically just show them that there's a new sheriff in town, that this place is not going to be for doing illegal activities and things like that. And also, you clean the place up and fix everything that needs to be fixed, just like a regular multifamily also. So, and those are the major value that you're adding to it. Get a better sign, basically, if it's not paved and if you think you can pave it, looks better and you can drive better on the surface, so that can add value. Also, in one of the storages we have, there is like a just random spots about good enough for space, but that's enough for 10 cars. So then we just also demarcated that space and then charge people like $50 per month to park there. So uncovered parking. So that's another, $500, right, per month of revenue. So those are just some of the ways that we do it. So I'll let Dave chime in.
Yeah, no, we are, and there's a ton of ways you can make money in self-storage. Our business model is we buy from a mom and pop operator that you mentioned. So we're buying from a mom and pop operator, and then we're getting it ready to sell to a REIT. And so during the hold, we usually project a 5 to 6 year hold. History tells you that we usually have a liquidity event somewhere between year 3 and year 4. But we're buying from a mom and pop operator. We're adding, we're forcing a bunch of value. We're adding climate controlled self-storage, climate controlled units. We're increasing the footprint, taking it from, let's say, a 60,000 square foot facility to a 100,000 square foot facility. So we're doing a lot of things like that, and we're bringing in professional management team to run it, bringing up the retail and U-Haul rental, bringing up the income from those types of sources, and really just prepping to exit to a REIT. So November, a year and 3 or 4 months ago, about 15 months ago, we sold a 26 property portfolio to a REIT out of Chicago. And our investor, it was a $450 million deal. Our investor netted between 30 and 31% annualized returns. And, that business model, there's a lot of margin there, and you can do really well. It's been very kind to us, but that's not the only way you can make money in self-storage. I love it as an asset class. Those assets would work very well for us just to hold them and produce cash flow for our investors for a long time. But that's our business model, and it's been very kind to us.
Awesome. Thank you so much. Yeah, I think at this point we can definitely keep going with self-storage. I know, Dave, you put together a presentation for us, and along with ATMs and car washes. We're happy to jump into that.
All right. Well, let's do this. I'll just quickly breeze through the first couple, and then we'll get into I'd like to hit on 2 different things because George, you mentioned there's quite a few physicians that'll be seeing this, and I wanted to talk about not only how to grow your wealth through additional income streams and that kind of thing, but also how to stay tax efficient, because that's kind of a big deal when you're in that space. You guys are used to working with people who make a lot of money, but it's hard when you're a W-2 or making a lot of ordinary income to stay tax efficient. There's ways you can do it, but it's hard. So we're going to touch on tax a little bit as well, but I'll just breeze through here. Let me see here. There we go. Trademarked this quote a number of years ago. You can be conventional, or you can be wealthy. Pick one. And it's really just talks about conventional. So let's talk about conventional in terms of building wealth, and we know what that is. That's buying stocks and bonds and mostly Wall Street products. That's conventional way to build wealth, and that's not us, and that's why we get together on these types of calls. A little bit about me. I built several successful businesses, got myself into a real tax. I was a tax slave. I built these businesses up, got to the point where I was making a lot of money. The businesses were doing really well. I was paying $500,000 a year in tax and got tired of it. Started getting around people who were sort of a lot more non-conventional and were making statements like these: you can make millions of dollars a year and pay no tax legally. I had to find out what that was about. This was way out of my box. I always thought if you make a lot of money, you got to pay a lot of tax. Well, this shook my world. If you want to change your tax, you got to change your facts. It was the first time that I realized that it was in my power to do to get myself into that tax efficient space. I didn't know that it was the choices that I was making was the reason I was paying, giving almost half my money back to the government. And so I got into the multifamily apartment space, quickly took my tax liability from $500,000 a year to zero. And then, in the last dozen years, I've, more than 10x my income and the interesting thing is my tax base is still in that 0 to low single digit range. So just, a decade later, I can tell you Robert Kiyosaki was right. You can make a lot of money and pay no tax. So where's the value in today's market? This is a tough market. You see one of the things I was speaking at the Best Ever conference, and it's a real estate multifamily apartment heavy conference in Salt Lake City last week. And one of the themes, one of the subject topics was, how do we survive to 2025? And I'm thinking to myself, like, really? Like, yeah, that sounds pretty bad. And I'll just tell you that there's some turmoil. There's some people that are suffering in that space. Just simply, one of the big reasons is 5-year rate locks are expiring, and some of these big assets. You're talking. They got into these assets at 3% interest rates, and now they're 6.5%. That's a problem. So which asset class makes sense in today's market? Sometimes you got to go out and create value. We talk about self-storage and creating value, creating, additional square footage, or bringing in professional management, or, forcing value. Sometimes that could be bringing talent and creating multiple streams of income through an asset that you have. The Inflation Reduction Act provides opportunity. Whatever you might think of that bill, and there's a lot of, bad stuff in there, and it's not good for our country, but it's there, and we get to live with it. And but there's some opportunity in that space. Renewable energy is a big thing. Just know that there's a bull market somewhere. There's opportunity somewhere in every market. So let's talk about a wealth building goal. I'm pretty sure you guys wouldn't be spending your Saturday afternoon here if you wouldn't have, some kind of aspirations to, get somewhere, that's bigger and higher and better than where you're at today. And that's a good goal. But one of the things that I'd like to talk to you about, I work with a lot of doctors and dentists and just, high income earners. Some have their own practices. Some are just, they're just out there. They're W-2 and they're making a lot of money, but they're on a hamster wheel. And, one of the ways to get off that hamster wheel is to have a goal to have your passive income exceed your ordinary income. Robert Kiyosaki talks about the rat race. And once your passive income exceeds your ordinary income, now you're financially free and you're out of the rat race. So that could be a goal of yours, to have your passive income exceed your W-2 or your ordinary income. So important questions to ask early on, like when you're doing the thing and you're trying to, and this is a question that I often ask an investor when they come to me asking for, wealth building advice and what do you do? And one of the things that very quickly in that conversation, I try to figure out, okay, well, how do you make your money? Like, how are you getting taxed? Like, is it all W-2 income? You got some passive income? Is it you own your own business, or how are you getting taxed? And when you ask yourself that question, there's so many different ways that you can offset the tax liability on your different streams of income. Do you know that paying taxes is not patriotic? If you really wanted to be patriotic, help your government do what your government wants you to do, and that is go out and start, go out and buy assets, go out and, which creates jobs for other people. Go buy real estate, apartment buildings, single family homes, whatever. go create value in your community, and your government will pay you. They'll pay you to go out and do those things. So really what you want to do is just, figure out what your government wants you to do and go out there and do it for them. And they will pay you to do that kind of stuff. Manage your tax liability. If you're paying 40+% tax, that is a dream killer. I mean, that's like swimming upstream. Like you want to swim with the current, not against the current. So I'll talk quickly about 6 different kinds of income. You got passive income, capital gains income, ordinary income. You got portfolio income, short-term capital gains, long-term capital gains, and then even within those two, those 2 last ones, you could be passive or active. But here's the 3 sort of main ones. You got ordinary income, passive income, and capital gains income. That's kind of the 3 that we're most familiar with. And, of course, the government allows you, there's so many, like I mentioned, there's so many different ways that you can offset the taxes on your income. And there's just some of them. And there's so many different ways, like it really, when you get down to the end of the year and you owe a lot of taxes to the government, it's really the government telling you that here's your fine for not doing what we told you clearly in the tax code, what we wanted you to do, and you just weren't paying attention. You just didn't do what we told you to do, and now because you weren't a good boy, we're gonna punish you. And so one of the things that I do, one of the things I've gotten really good at for myself, and now also helping a lot of investors do it, is to take those different income streams and sort of put them into like a column. Like you got your ordinary income, you got your passive income, you got your capital gains income. Let's say you sold something. Maybe you're in a spot. Hopefully, if you are, hopefully you won't be there long, because we're going to talk about ways you can build your passive income streams. But maybe you're in a spot where all you've got is ordinary income or W-2 income. Okay, so there's ways to protect yourself there. But I always tell people, look, if you're making a lot of money, you're making a lot of ordinary income, you should always be building your passive income column. You want to get to the point where you're making more money on the passive side than you are on the active or ordinary side. And so let's walk down this path together. Let's say that you've got income in the, you've got an ordinary income column and a passive income column. And let's say you want to start protecting some of those, or just start building some of those passive income columns. There's a couple different assets, and our funds. Right now we've got 3 funds open. We do a lot of car washes. We're one of the biggest car wash, Tommy's Express car washes in their entire organization. We're currently right around number 2 right now, and we'll be number 1 probably within we're on the path to becoming number 1 in their entire organization. So car washes can be a great source of passive income, and they will also protect you from being taxed. There's a lot of depreciation. If you look at that picture, car washes are unique in that you can take 100% bonus depreciation on not only the equipment but also the building. It's very unusual. That's only for car washes and gas stations. Don't ask me why. I have no idea why. I must have had some good lobbyists or something. But these assets are really just a reflection of my own portfolio. A lot of people think that I'm out there running around trying to find asset classes to start up a fund that I think my investors will want. It's not like that. It's not like that at all. What I do is I find an asset class that I really like. I find an operations team that I really like, that works for me and that I love doing business with. Then I share them with my investors. And so these are the asset classes that if you look at the 3 to the right, the self-storage, the ATMs, the car washes, those are passive activity. So that could offset the tax liability on your passive income column. If you look at the one on the right, you got commodities, you got natural gas, you got oil, you got solar, renewable energy. There's a lot of stuff in that Inflation Reduction Act bill that supports some of those asset classes, specifically renewable energy, solar and nuclear. So there's ways that you can offset the tax liability on any one of your income streams and build yourself, aggressive cash flow streams going forward. So we never look at any one of these asset classes and say, okay, this is what we need this from a tax perspective. This works from a tax perspective. No, we start with the asset class first and make sure that it gets you the cash flow, the income, the equity appreciation, whatever it is that you're after. Make sure that's a good fit there. And then if we can, use depreciation and make depreciation be our friend and wipe out the tax liability on the income, either coming from that asset that you just invested in, or you can take that and move that over and wipe out some tax liability on some of the others. So I'll stop there. I can dig into any one of these asset classes. I know we were kind of talking a lot about self-storage early, so I don't know if we need to go back there, but there's two specifically that we can talk about. And then if you guys want to talk about natural gas and some of those things, we can as well. So I'll stop there for a minute. And if you guys want to dig deeper into car wash and ATMs right now, we'll do it. You just tell me where you want to go.
I think that's a great idea, just because it's such kind of a foreign kind of concept of how it works, how it generates income, how it creates income for passive investors. So I'd like to start with ATMs. Could you kind of talk about how the revenue is generated? And then also, I'm very curious about your take on the future of ATMs as we progress to maybe a more cashless based society and economy.
Sure. So in its simplest forms, somebody walks up that ATM machine and does one of 8 or 10 things. And the most popular, or the most where most of the surcharge revenue comes from, is for somebody to put a card into that machine and they get cash out, right? That costs them $2 or $3 to make that happen. Many people think that $2 or $3 goes to the bank. That's not true. Many times that's going to investors like us. And so this is, oftentimes that's a private individual or private group, private equity firm, depending on the size of the company. That's a group that owns those machines. So one of and just like self-storage, you mentioned, there's several different ways to really monetize this business model. You can have a mom and pop. You can have mom and pop make, servicing 50 to 100, 150 of these machines and doing it all themselves. It can be a very good business, can be a lot of margin there. It's not very scalable. Well, what we do, being number one, top 4 in the space now, what we do is we operate much closer to what it would look like on an institutional side. We take down large portfolios of ATM machines, and just like there's a infrastructure built around like self-storage or multifamily, you got your lenders, your brokers, your property manager, you got that whole infrastructure built around apartment buildings. You got that for ATMs too. It's just a smaller, nichier product. But so being one of the top 4 in the space, yes, we're in there. We're seeing these portfolios, and when we buy a portfolio, we're unseating somebody, and that's important. That's important to realize that we're not just going out and we're placing ATM machines all over town and hoping they work. Two of the reasons that's really important is, number one, saturation. We're not going out and providing saturation by placing new ATMs and a bunch of other places. But maybe even more importantly, we know when we go in and take over a portfolio, it's just like somebody would ask for a T12 or a 12-month rent history on an apartment building. We're getting the transaction history. We can look back 2, 3, 5 years and see exactly in each one of those locations how many transactions happen at those locations. So we're going in eyes wide open. We know exactly what those locations will have delivered for the last couple of years. And then we can see, okay, does this fit our model? So then what happens is you have a number of transactions, some ranging from 200 to 500 to 1,000 to 2,000 transactions per month. Many of them, when you're getting into what we would consider a healthy location, you're in that 400 to 600 transactions per month range. And so, now you're looking at, what does that look like for an investor? So an investor will make they will get paid on a portion of that surcharge revenue. So that $2 or $3 charge coming to the company will get split up in three ways. The investor will get around 30-ish%. The location agreement will take about 30-ish%. And the management team will take about 40%. And so all of your costs and overhead and your team and your in-house and out in the field, and all of your costs get run through the management team or through the management company. So the management company takes about 40% of the revenue, and then 30% the investor, 30% to support the location. So that's really the business model. We can talk about numbers if you want. We can talk, what the monthly payouts look like and kind of the cash on cash return. Do you want to go there?
Yeah, please.
Yeah. Okay. So normally it would be a $2,162 per month, and it's a 7-year contract. The investor comes in, they sign on to the deal. It's a 7-year deal. You get a monthly distribution, 84 monthly payments, over 7 years. $2,162 per month for that period. So that's about a 26% cash on cash return, between a 19 and 20% IRR. The reason the IRR is higher than the cash or lower than the cash on cash return is it takes into account that you're losing the value of your ATMs over that 7-year period, right? So, over the 7-year period, you don't get to, it's not like an apartment building or a self-storage facility where, at the end of the 7 years, then you sell the asset and you make some money on the asset. It's not like that. So you're getting your return over that 7-year period. Here's where it gets really fun. So when you take 100% bonus depreciation, this year it's 80%, then you get the remainder in the subsequent years. But let's say you take 80% bonus depreciation in that first year, and then you consider that first 12 months of cash flow, you're getting roughly 60 to 70%. If you're a high taxpayer, where like most of our investors, you're getting roughly 60 to 70% of your principal off the table in that first 12 months. From the start of your cash flow, you go out 12 months, you use the depreciation, you're getting 60 to 70% of your principal back in your pocket. Then you get an additional 6 years of cash flow behind that. So it's an interesting investment from just strictly a cash flow perspective. But when you roll in the depreciation and get it to the point where you start knocking down big chunks of your tax liability, it's one of the ways I stay tax efficient is using this asset class. Very aggressive cash flow play, very aggressive tax impact play.
Right, kind of like an oil and gas working interest. It's considered a sunken cost. Is that correct?
No, it gets you to the same place, but it's not in oil and gas. You'd be looking at sunken costs would be your IDCs, intangible drilling costs. Yeah. Here, you're buying equipment. You're buying a piece of equipment, and you're able to take 80% bonus depreciation. You're able to take 100% bonus depreciation, but you get 80% in year one.
Got it.
Yeah.
So it gets you. So to your point, you sort of, yes, it gets you to the same place, but it's a little bit different in that oil and gas. You're talking IDCs and an intangible drilling cost. Here, you're talking a hard piece of equipment that you can write off in year one.
Gotcha.
Yeah. When George talked about the sunken cost, I think he was talking about the fact that once you put in the money, the investment, it's not like multifamily in which we give you back your capital back at the end and then give you the extra equity on top of it at the end. But you're getting your capital back slowly through the cash on cash, right? So that's why, it's just a little bit of a different setup.
It's very different, and I'm glad you mentioned that because there is a big difference in this depreciation. You never have to recapture this depreciation, so you really got to count it as cash. Okay, so consider this: when you buy a multifamily apartment building or a self-storage facility, and you do a cost seg study and you accelerate your depreciation or whatever, you get a big old tax break. And that's all good. You should do all those things. Then you sit there and you collect the cash flow, for whatever 5 years, 7 years. You sell that asset in 7 years, and hopefully for a nice profit. You not only pay the tax on the profit, but you also got to recapture all that depreciation, all that tax impact that you enjoyed 7 years prior. You now recapture that thing, and you get to pay tax on that. It's not like this on an ATM. The depreciation that you claim on an ATM, you never recapture that.
That make a big difference. That's good. Yeah. Ruben, can you come on? I think he has some question for you.
I can read it out loud. So the question is, how are you going about finding the ATM and car wash deals?
Yeah, so good question. We talked a little bit about the infrastructure. Let's talk about ATMs. We're one of the big players in the room. It's no different than, if you were in the multifamily apartment space and you were top 10 in the country. You have a presence. You know what deals are out there. There's brokers talking to you every day. You're seeing these portfolios. You're in the room. So we're very well connected in the ATM space, as you can imagine, being top 4 in the space. So we're constantly monitoring those, and if there's a big portfolio, we're into a big portfolio right now that's between 5,000 and 6,000 ATM machines, and so we see those things on a daily basis. Car washes, that's a little bit different in they don't come in like portfolios of lots. Like, we're building these car washes from the ground up. And so we're finding premium lots, acre and a half. We're paying normally between $1.5 million to $2.5 million for that lot. We're paying a premium for the land, but it's very important for us to be right in the hot zone. We want to be right where the Chick-fil-A and the supermarket and we want to be where people are coming, where people are coming to. You almost, in that business model, you almost can't pay too much for the real estate, because you're talking about having a business on top of that real estate for the next, 20, 50 years. And so, the price for the land becomes almost irrelevant when you look at it over a broader picture for the next, 20 years, 10 years. And so, and also the valuations on that business is based on the net operating income, or the income that's coming from that business. Better the location, the more traffic, the better the income, the more value or the more premium is built on that business. So we're going out a number of different ways. One of the things we've learned over the last couple of years is, like, normally a Chick-fil-A location is a great location for a Tommy's Car Wash. Same sort of demographic. They spend millions of dollars on their studies and those, so we kind of ride on their coattails and get a free ride. But we actually hired a broker that was doing primarily Chick-fil-A lot. He was going out finding lots for Chick-fil-A's, and oftentimes, of course, there'd be another lot right next door, or just down the street from that. So we hired a Chick-fil-A broker to find us those lots.
That's good.
Clever. So Temi had a question. I wanted maybe you can come off mute and give it context. Maybe you had it specifically when Dave was talking about a concept, but is that a fixed amount? Let us know which part you're talking about.
Yeah, so Temi, you're welcome to jump on, but I think what she's asking, that $2,162 per month that I mentioned, is that a fixed amount? The answer is yes. What we do is there's about a 28% margin buffer built in between us and our investors, meaning the transaction volume could decline between 25 and 30% before our investors would feel any kind of negative impact. On the upside, so what happens? Let's say there was so investors come in, they invest $104,000, buy one unit. One unit is 5 or 6 ATM machines. And then those 5 or 6 ATM machines get placed in a fund, in our fund, and we manage the fund. And then the investor gets paid a blended performance. Their monthly distribution is based on the blended performance of the entire fund. So they got exposure to every ATM in that fund. What happens is if that would happen to be less than $2,162 on any given month, management, we would come up with the arbitrage between, let's say in month one it would only be $2,100. We would make up the 62. Let's say in month two it would be $2,400. Then we keep anything over 2,162. So it's a way that we can get in there and provide stability, because there is some volatility. You got some months where we just know that March is going to be busy. It always is, but September is going to be a little slow. It always is. So you got some of that going on. So we know there's going to be high months, low months, whatever. We provide that floor, but then we also keep the upside, anything over 2,162. So yes, the answer to the question is yes. It is a fixed amount.
And what's the feedback from your investors on this kind of model? And I'm just curious, maybe it could be translated into like storage or multifamily. How you basically have like that fixed, return sort of a thing.
Yeah. So I mean, it is a business model that has worked very well for us. Investors love it because it provides a predictable monthly cash flow. They don't have to guess, and it works well for us too and it aligns us very well with our investors as well, because the better that we make this portfolio perform, the more money we make. If we can get it to perform at 21.82 and we keep $20, great. If we can get it to perform at $20 higher, great. So we're highly incentivized to make this portfolio perform very well.
Yeah, thanks.
Circling back to question about the future of ATM usage.
Yeah. So we are, as you can imagine, we're watching this stuff. We're listening to this stuff. We're doing our market research, and we're seeing what's going on around us. What's even more telling is we can see exactly how our customers are behaving, inside our fund. We can see if it's trending up, down, sideways, volatility. Of course, we got a front row seat. But unlike what most of the people in our peer group would think, we would all tend to believe that use of cash is dying because none of us use it much. I couldn't get cash out of it. I own hundreds of ATMs myself personally. I couldn't get cash out of one of them if I wanted to. I don't use much cash. Many of our peer group uses plastic or digital. And so, but what the biggest thing to understand here is there's more cash in circulation today than there was last year. There's twice as much cash in circulation than there was 11 years ago when we got started. The other thing that may be even more important is the people who use cash. That demographic is one of the fastest growing in the country. So you're talking lower income, EBT card carriers, immigrants, immigrants are using ATM machine as their bank, and they're sending money back home instead of using the old Western Union model where they'd have to give up 10% of their paycheck to get the money back home overseas. They can now do it for $2 or $3 and send that money back. So I talked about 7 or 8 different things that you can do with an ATM machine. I'll just name a couple. I mean, you can cash checks, you can deposit checks, you can get cash out. You can some of the machines you can get you can trade cash for Bitcoin. You can man, there's more.
Are you guys international?
You can send your college student a code, and you can go to the ATM machine and get cash. You can send money overseas to your family. There's a bunch of different ways you can monetize this machine above and beyond just putting your card in and getting cash out.
Got it. That just, brings up a point about how, folks are sending money international. Are you guys also international?
The closest thing we have to have an international exposure is we got a large portfolio in Puerto Rico. That's not really international. That's U.S., but it sounds international.
Sure.
Good. Okay. We haven't talked about car washes much, so I'd like to know a little bit more about that. And if you guys have questions, please type it in the chat so we can circle back to it.
Yeah. So sure. So what we're doing is we're building car wash. When we first started it, when we first got started in this space, we thought we were going to build 40 or 50 car washes in 5 years. When we saw the opportunity and saw what was going on in the market and saw institutions just like tripping over each other trying to get into the space and how fragmented it was. You talked about fragmentation in the self-storage space. I would say the car wash space is like micro fragmented. It's like you have Mr. Car Washes, the biggest player in the space, and they equate for around 5% of the global revenue. The biggest player in the space does about 5% of the revenue. So it's like micro fragmented. So you got institutions scrambling to get into the space, trying to get their foot in the door. We've seen 20 car wash portfolios, 20 well-run tunnel wash portfolios trade to private equity firms, institution for an 18 to 20x multiple on EBITDA. So that's saying that's telling me as the operator, that's a buyer coming to me as the operator saying, look, I'll pay you the income for the next, I'll pay you the profits for the next 18 to 20 years today if you sell me this thing. And so what we're doing is we're building car washes thinking we're going to sell in 5 years or less. And we're on pace to build between 80 and 100 in the next 5 years.
That's pretty good. 18x. Most businesses I find between 3 to 5x. So yeah. That's
and here's the thing. We would love to. I mean, this is a great business model. We would love to hold 20, 50, 100 of these things and just manage them and cash flow them till like nobody's business. But when somebody's willing to pay you an 18 to 20x multiple on that asset, it does. I mean, you can't only afford to keep it. So it's not that we're building this thing, watching what's going on in the space in the world around us, and really as an operator, you want multiple options. That's an option. Just keeping these things and operating and providing cash flow is another option. Either one of them will work for us.
What's the cash flow like? I know this one is much simpler than the ATM it looks like, right? People are paying you to do the car wash and then you distribute it to the investors. But, just to kind of explain to us what kind of returns you're getting for car wash and how people can get involved also in general.
So we're operating on a 45 to 50% margin on these. I mean, the operating margins are some of the most aggressive I've seen anywhere in any business. And so what we did for investors, this was as of 3 years ago. This was a new asset class for us. We were dealing with a new operations team, which we hadn't done business with before. They came to us highly recommended, and we did a lot of research on the operators. Very happy with them. We saw them do some amazing things, and right now we've got 8 operational, and we got 7 more coming out of the ground right now, being built. But the operating. So what we did is we said, okay, to reduce the risk. You got development going on in the fund. You got a new asset class. You got a new operations team. You got economic risk. Although this is an asset class that has proven to be very recession resilient in the pandemic and in 2008 to 2010. So we feel really comfortable about that. But we were like, okay, so we got all these risks. Some of them are perceived risks from investors, and some of them are very real. How can we reduce the risk? So we decided we'll give the investor 100% of the cash flow. They get all of the cash flow till they get to 1.75 times their money. You invest $100,000, get 175,000 back, and then they exit. So we're tinkering with. I mean, we've run on that model for the last, I don't know, year and a half, and there may be an equity model coming out. Not sure, but that model's been working very well for us. Investors get all of the cash flow, so every dollar that comes out of the deal, we're working for free until they get to the 1.75x. And it's really, again, it talks about aligning. You know, I talked about aligning yourself with your investor. You know, you talk about, you know, we're heavily incentivized to make the ATM portfolio perform. We get paid behind the investor. Same deal, even more in this case, where you're paying 100% of the cash flow to the investor. We just got off. I mean, we've got other asset classes that have done really well for us. Told you about the self-storage exit. We don't need the money, so we can afford to work for free. We're really on our side. We're working. We're investing for appreciation, future appreciation. Investors are getting the cash flow.
Yeah, I mean, in many of the multi-families work the same way, that most of the general partner, the money you really get is displayed. It's usually at the end because you do the preferred return. But this one is definitely different. But what I can say is different is the fact that the investors have to exit. So what if they want to stay on, or I guess they have to get into another fund?
Yeah, so right now that is not an option to stay in. You get 100% of the cash flow until you get to your 1.75. And here's the upside in that: we're getting offers. We're getting aggressive offers to buy us out already. Institutions are so desperate to get in this space. They'll pay you for stabilized assets. They'll pay you for finished assets that aren't stabilized yet, just in the ramp up period. They'll pay you for half-built assets. They'll pay you for fully entitled assets, and they'll pay you for your land that you're going through the entire. They are so desperate. And one of the things, couple of things that is important to know and understand about institutions, their money isn't patient. Like, they can't buy these lots and go through the entitling process and go through 2 years of like township meetings entitling before they're allowed to build on it. That doesn't work for them. So there's kind of this moat that kind of protects developers like us that come in and actually build these from the ground up. So we're building to exit, and if that exit happens in 3 years or 4 years, investors still get the first 1.75x. Their IRR goes through the roof because they now get that 1.75x in whatever 3 years or 4 years instead of 5 years.
Yeah, I'm in a lot of build to rent development. Same thing. A lot of institutions are interested in it. They're buying it before it's even finished being built. So we're at.
And it's very different from the self-storage model. There, it's an equity model. There, it's 70-30 split, more along the lines of a conventional syndication, where there's an 8 pref or 9, actually a 9 pref to investors, and then a 70-30 split behind that. So, and then the investors, in that deal all the way to the exit. There's different deals that we do that have different deal structure. The car wash just happens to be a 1.75x. We felt like, it aligned us very well. We felt like we were investing for appreciation. Our investors are investing for cash flow. It's worked very well so far. We may, in the next year or two, come out with some sort of a hybrid model, maybe an equity model. I'm not sure, but that's been working very well for us. And quick return of cash. It's a cash flow play. It's a cash flow play, and it's a very aggressive tax play. And again, in this model, there's no recapture of the depreciation. There's a lot of equipment, and the building is almost like, in the eyes of the IRS, it's like a piece of equipment. You can you can depreciate at the same speed, so you never have to recapture that depreciation.
That's another question I wanted to ask. Can you deduct this against W-2, or it's only passive to passive, like multifamily, or does it work like oil and gas, in which you can do against W-2?
It is considered a passive investment. So we operate, we manage, we do everything. It is considered a passive investment for our investors.
Okay, so it has to be from passive to passive. So, like for multifamily, you can be real estate professional, right?
If you're a real estate professional, it would work the same way as if you were in the multifamily space. As long as you were involved and you had the real estate professional status, yes.
Okay, even for
most W-2 employees, that may not be an option. So, but yeah, real estate professional, that's a different story.
What about for ATM? How does the tax benefit work? Is it?
So we do a lot of business with a lot of dental groups and, guys who own their own practice. We set it up. We have we have two different funds. We have Prestige Fund A. That means that Prestige Fund A, we sell you the ATM machines and get you a bill sale. You can take that to your CPA. You can write it off as, you have flexibility there. Prestige Fund D, we deliver you a K1 that clearly calls out that it's a passive business activity. So Prestige Fund A gives you some ability to get creative on the tax side, but it's we need to know that up front.
Okay.
So we have two funds running simultaneously, and they're, from an investor's perspective, the only difference is no difference in economics, no difference in distributions, any of that stuff. The difference is the one comes with an annual K1, the other one comes with a one-time bill of sale.
Okay. Yep. We're gonna give option for someone, if you have any question, to come on or type it into the chat. Otherwise, it's 5 o'clock, and then we're gonna be rounding up. And in the meantime, I'm going to just make some announcements. So the next one on April 1st is going to be Pascal Caucus. And we met him in Tampa, and it does multifamily short-term rentals. And so please join us. And also on April 15th, it's going to be Wagner Nolasco. We also met him in Tampa, but he's based in Orlando. Is that true, George?
Yeah, he's in the Orlando area.
He's in Orlando area. So, so it'll be fun. So anybody have any questions?
Dave, I see you left an email. Also wanted to just, give you opportunity if there's any platforms that they can reach out to you other than your email, any social media, on your website, things like that.
Yeah, so our website is therealassetinvestor.com. And the best way to get to me is the email address right there. It not only gives you access to me, but it gives you access to every member of our team. We're very responsive. So if you have a question, or if you want to see marketing materials or investment summaries on any of the three asset classes that we talked about, self-storage, car washes, ATMs, feel free to. We also expect to have a natural gas fund open in the next couple of weeks. That one, as you guys are familiar with, that one will give you tax protection against ordinary income, W-2 income. That's an asset class that I'm very bullish in personally, and I've been a natural gas investor for almost 5 years now, and I'm more bullish today than I've ever been.
Okay, we actually have did some oil and gas funds, and we have talked about some carbon capture technology also in the past by Eric, yep. And I'm just curious. Most of the issue we find is the minimum for many of these funds are like $200,000, $250,000. for many of the oil and gas funds. So you have to do like a fund of fund kind of a thing. So what's yours in general?
We have $100,000 minimum.
Okay. So that's just something to think about. Okay. Thank you very much, Dave.
Awesome. Well, there's no more questions. I think it's a good time to wrap. Just want to thank Dave again for coming on and sharing the information with us. And if you want to reach out to him, you have his information here. Until then, we will see you guys in 2 weeks for our next series.
Thanks, guys. Thanks to everyone who was on, and we'll see you, George. I'll see you in Dallas coming up here next week.
I'll see you in a week.
Okay. See you guys.
Thanks, guys.
Okay. Bye.